Today we're going to be talking about real estate stocks and what are the best 5 REIT stocks in Canada and how you can collect rent every single month without owning any properties. Let's go. Hello everyone, my name is Alex. Welcome to my channel. I hope you're doing well. I hope you're staying safe. Today we're going to be talking about REIT stocks and what are the best 5 REIT stocks in Canada. And REIT stands for Real Estate Investment Trust. And to make it easy to understand and grasp, it's just real estate stocks, companies that own real estate properties like different office buildings or retail or industrial properties, say medical centers and stuff like that. And then they rent out these properties to other companies and then they collect rent. And then they pay this part of the rent to their shareholders in terms of distributions, which is some sort of dividends. They're just taxed in a little different way. So the important part here is that if you want to invest into REIT stocks, you better hold them on your tax shelter account, like TFSA, RSP, RESP, just because you don't want to pay any taxes on all the distributions you're getting. And why are these REIT stocks actually interesting? So for some people, they like to manage all these properties, they like to deal with their renters and all that. But for many others, being a landlord is actually a headache they don't want to deal with. And that's why there are these REIT stocks that you can invest to and become a real estate investor. So you sort of own part of these properties and you actually collect partially rent for all these properties, which is pretty cool. And you can consider yourself a real estate investor when you're doing this. The other part, if you deal with the physical real estate, it's really hard to get into different sectors of real estate, like industrials or office buildings and all that. But when you deal with these REIT stocks, you actually can do this because there are companies that own real estate properties in all these different sectors, like retail properties, offices, industrial properties, healthcare buildings, hotels, and stuff like that. The other good part about REIT stocks is that they pay distributions, so-called dividends, every single month. And that's better for you, right? Because you collect these distributions every single month, and that can become a significant income source that you can rely on every single month. Also, REIT stocks perform slightly differently from other stocks and companies during the different economic or stock market conditions. And one of the main metrics we want to see for these REIT stocks is the cash flow that they're getting, because that tells us if they can sustain the dividend, if they can increase the dividends on a regular basis. So enough for the start. Now let's dive into top 5 REIT stocks on Canadian stock market. And the very first one is Choice Properties. The ticker symbol is CHP-UN.TO. And Choice Properties is a real investment trust that owns, manages, and develops retail and commercial real estate across Canada. Choice Properties was actually spun out from Loblaws in 2013, and now this grocery chain is actually one of the biggest tenants today. The real estate properties for this company are located across the largest markets in Canada. Approximately 57% of the rent that is collected is coming from the urban areas in Canada, like Toronto, Montreal, Calgary, Vancouver, and small and medium urban areas are getting around 28 to 15% respectively. And Choice Properties is actually one of the largest REITs in Canada. It has around 750 different properties. The majority of the properties are coming from the retail, around 560 of them. Then the next sector would be industrial, around 110 different properties. Then they have around 16 different office buildings and around 20 of different development properties. Now let's take a look at our metrics board. So the market cap for Choice Properties is around $4.34 billion. The yield is actually pretty good as well, is at around 5.5%. The payout ratio for Choice Properties is around 54%. So that means that they still have enough money saved up from their earnings that they can reinvest back to their business. Looking at the share price growth for the last 10 years, Choice Properties is around 30%, which is not great, but again, we are looking here at regular payments, regular dividends that we want to get, right? So as long as the stock price is not decreasing, we're good. And if you take a look at the performance graph for this stock for the last 10 years, you can see the stock price was actually in a good state all the way until recently, when it dropped significantly in March last year. So we know what happened there, the market crash of 2020. And as you can see right now, the stock hasn't fully recovered yet to where it was before the stock market crash. So we still have this opportunity to actually gain some of the stock price appreciation in the next year or two. So next parameter is our beta parameter, which is the risk level. And it is at 0.5. So which means that this stock is actually a low risk one. It's actually 50% less risky than the average stock market. So we're totally good here. And the final parameter here is our drip amount. So how much money we want to invest in order to get enough dividends paid back so we can reinvest back to this stock. And Choice Properties here is actually at the lower number, which is $3,000. So with $3,000 investment, you can get a single share of Choice Properties every single month, and that will get you 12 shares per year, which is great. All right, let's move to the next one, which is HR REIT. And the ticker symbol is HR-un.to. HR REIT has interest in a portfolio of office, retail, industrial, and residential properties, spanning across 41 million square feet in North America. And HR, being one of the largest REITs, has assets worth around $14 billion, which is insane. It enters into long-term lease, including rent escalations with creditworthy tenants. This company has 4 types of different assets. Office, around 50% of total assets, retail, around 30% of that, multifamily, that would be 13%, and industrial would be 7%. And if Choice Properties was a lot into retail, now HR is a lot into office buildings, which is good. Now we're seeing that we're diversifying our portfolio if we go with these stocks altogether. By geographic region, Ontario and USA actually accounts for around 33% of the total fair value, closely followed by Alberta, which is 25%. This company focuses on high-quality investment properties in North America with quality tenants ensuring stable cash flows. And let's take a look what our metrics says. So the market cap for this company is around $4.28 billion, which is good. It is large enough, it's not going anywhere. The dividend yield is at around 4.74%, which is all right, and it's still pretty generous. The payout ratio for this company is around 100%, but because they have a very stable cash flow, we shouldn't worry about that at all. The share price growth for the last 10 years is actually not great. It's actually pretty much the same as it was 10 years ago. But if you count for the market crash of last year, we actually are down in pretty good conditions. Let's take a look at our graph. As you can see here, we have a pretty crazy share price drop during the stock market crash in 2008. But you can see that the stock price actually recovered in a couple of years after that. And today we can see a very similar situation where the share price dropped significantly during the last year market crash, almost 60%, and now it started to come back, but it is still a 30% discount if you compare it to the pre-market crash share price, which means for us that we can still benefit from the share price growth in the next year or two. Looking at the beta parameter for our risk is actually at 1.89. It seems like it's a pretty risky investment, but I think it's still worth it because you can gain from a high yield and also a share price growth over the next year or two. And looking at our DRIP amount, it's at $3,900, which is at lower or medium range. All right, next one is SmartCenters REIT. The ticker symbol is SRU-UN.to. And I added this REIT into top monthly paid dividend stocks in Canada. I talked about it in one of my recent videos. I'm gonna link it above here, so go check it out. So SmartCenters is actually one of the largest developer and operator of shopping centers. And if you ever been on a Walmart Plaza before, you probably step your foot on the SmartCenters properties. SmartCenters engages in the acquisition, asset management, planning, development, leasing, operations, property management, and construction of property. SmartCenters' growing platform includes value-oriented unenclosed shopping centers and destination outlets. This REIT currently has around 3,000 tenants and 34 million square feet of leasable space, available across 150 different locations across Canada. More than 100 of the centers are actually Walmart shopping centers. Let's take a look at our metrics here. So the market cap is around $4.5 billion. The dividend yield is actually at 6.96%, which is great. And moreover, this company is a dividend aristocrat, which means that they increase their dividends for at least the last 5 years. And for them, it's been 6 years. Crazy. And their dividend is not going anywhere, and most likely they're gonna keep increase their dividends year over year. And the payout ratio is actually pretty high. It's around 400%, which means that they still burn through cash in order to pay out the dividends, but most of it, because of the last year shutdowns and market crash, we're still in shutdown actually, but they're gonna recover very, very soon, I think in the next year or two. And by that time, the payout ratio should go back to the more normal levels. Looking at a 10-year share price growth is actually not that great as well. The price is actually pretty much the same as it was 10 years ago. But again, let's take a look at our chart. So we can see here that it has dips during the different market crashes, 2008 and then another one in 2020. But as you can see here, the same situation, we still recovered like halfway through for this share price. So there's still room, and they're gonna come back where they were before the market crash of last year. I would say it's still very safe to invest in this company and gain this monthly paid dividends with a great yield, and also get this share price appreciation in the next year or two. Our risk level is also not that bad, is at 1.21. So we're safe there too. The DRIP amount is actually a little bit high, is at around $4,700, but that means that if you still haven't contributed into your TFSA account this year, you have $6,000 of room left, so you can put $4,700 into it and get automatic reinvestments for SmartCenters. Alright, next one here, which is Allied Properties. And the ticker symbol is ap.un.to. And Allied is the leading owner, manager, and developer of urban workspace and data centers in Canada. It's a real estate investment trust which started with a focus on Class 1 workspace. Allied owns 160 urban properties, spanning across 11 million square feet in Canada. Its portfolio comprises of a balanced mix of new and historical buildings. Office spaces actually accounts for a larger portion of their portfolio, it's around 69%, followed by urban data centers is around 18%, and then retail is around 10%. Also, Allied Properties has a subsidiary, Allied Properties Management LP, which provides property management and other fee-based services. Now let's take a look at our metrics here. So the market cap is around $5 billion. The dividend yield is around 4.08%, which is pretty generous for a company like this. The payout ratio is actually sustainable and very good, is at 41%, which means they still have some cash left out, so we can reinvest in their business as well. The 10-year growth price is actually pretty good here too, it's around 90%. So we're seeing this steady price growth over the last 10 years. And if you take a look at our graph, you can see that over the last 10 years, there was a steady, very good share price growth. And then it dropped significantly in the last year market crash, right? And now we're getting to the situation where we're starting to come back here in terms of the share price, and it's gonna go to the pre-market crash prices of around $50 or so. So we can still benefit from the share price growth here in the next 1 or 2 years, and also get these dividends paid out every single month. Our risk level is at 0.81%, which makes this stock a low risk investment. Looking at DRIP though, it's actually pretty high. It's at $12,300. So it's not that easy to get to this DRIP amount, but you can start with regular contributions and eventually you will get there. And the last one for today is the Summit Industrial Income REIT. And the ticker symbol is SMU-UN.to. This REIT focuses on owning and operating light industrial properties in the country. It boasts an ultra-high occupancy rate that allows the REIT to generate substantial cash flow, which is what we want. It has a sustainable dividend payout ratio and the ability to maintain a compounded annual growth rate of 8%. So for this one, we're gonna benefit from the very high dividend yield and also pretty good share price appreciation year over year. Allied Properties is also a dividend aristocrat stock. They increased their dividends for the last 8 years. So we're pretty safe here in terms of dividend increases as well. Let's take a look at our metrics now. So the market cap is around $2.3 billion, which is good. This company is large enough, so we are not worried about that. The dividend yield is around 3.83%. The payout ratio is actually at a very good number, it is around 38%, which means that besides paying these dividends on a regular basis, they can also invest in their business in order to grow it. Looking at a 10-year price growth, it's actually at an insane number at 190% over the last 10 years. Let's take a look at our graph. You can see here that for the last 9 years, so starting from 2012, you can see that the share price grew over 190%, which is great. And you can see that during the last year market crash, the stock price actually dropped significantly. And moreover, you can see that it actually went beyond what it was before the market crash. So this stock is definitely going to perform very well in the next 5 to 10 years. So you're going to be benefiting not only from the payments every single month, but also this company is growing pretty good, and you can expect it to grow at around 4 to 5% every single year, which gives you a compounded growth rate of around 9%. Our beta parameter is at 0.84, so it's a pretty low risk investment as well. The DRIP amount is actually pretty affordable too, it's at $4,500. So all in all, if you create an equally weighted portfolio from all these 5 stocks that I mentioned today, you're going to be getting a dividend yield at around 5%, which is great. You're also going to be exposed in different real estate sectors, like urban and offices, and industrials and retail and all that, which is great as well. So your portfolio is going to be very well diversified in terms of real estate. Also, it's going to be generating a sizable income that you can rely on every single month, which is great and what we want from these dividend stocks. But remember to hold it on your tax shelter accounts like TFSA, RSP, or RESP, just to avoid all the hassle with taxes. And thank you very much for stopping by. Like this video, subscribe to my channel, hit the bell, and I'll see you in my next video. Cheers, bye.